Good day, traders. This is Dennis Wilborn from the Active Trend Traders. It is Friday, July 10th, 2015, and I want to share a real quick tech tip with traders who are trading the Strategy 3 with the Active Trend Trading System. I want to remind everybody that all the materials we do present with the Active Trend Traders are for training purposes only, and traders should always paper trade any new method prior to the risk of their own personal capital. So today's tip is how to trade weekly options for wealth and income generation. To trade this strategy requires a couple of things. One is to ensure that you have an open long position. And how we're doing this is we have an open long leap calls and puts in an index ETF. We like the index ETF because there's a lot of liquidity for both the options and for both the weekly options and the longer term options. And then what we do is once we establish the long positions, we then sell calendar spreads against it, or in other words, we sell weekly calls and puts against the long leaps. But which weekly options do we buy and what day do we want to do this on? We're trying to get this strategy down to as close as possible to kind of a fire and forget kind of approach, where you place the trade on Thursday or Friday of this week, and then the weekly options will expire Friday of next week. We use a weekly chain to determine which options will do two things. One, pay for the long position during the life of the leaps times two. In other words, we want to make back 2 times what we paid for the original long leap position. Then we sell weekly premium that has a high probability of expiring worthless. We typically don't let them expire worthless because we'll be rolling the short positions at the end of next week. So, but is this a strategy worth your effort? I think it is. Here's a little example of a trade that I started putting on back in April 20th, 2015. I think the stock market's going to go down sometime within now and 2017. I think it's going to be a very significant correction. So what I went ahead and did is I bought 5 contracts of the January 2017 210 puts on the spiders. I paid 21 bucks for those. So I've got about $10,500 invested in this, and since that time period, I started on April 27th, I started selling weekly premiums against this position. To date, we have collected a total of about $2,677. So we basically returned about 25% on our original position. I don't care if this position up here, actually the long position, if it expires worthless, because I'm going to be generating weekly income on this as we go, with the objective of returning my total investment plus 100% of it. So at the end of when it expires in 2017, I would have liked to have collected $10,500 plus an additional $10,500 during that time period. Here's how we've done so far, and we're generating about $1,078 per month, and so we're right on par to meet our objective. So how do we set up a trade like this? Well, let's take that we are going to do this with the IWM. IWM, which is the Russell non-leveraged ETF, and let's say I bought contracts in this the January 16th. That expires the month of January in 2016, about mid-month. I entered the trade on 6/18. At that time period, there were a little bit over 30 weeks remaining until expiration. So I paid a total of $1,380 for a combination put and call contract. Some people call that a straddle. Which is, in fact, it is. And then what is required to pay off, in 30 weeks, this amount? Well, it comes out to $45.35 per contract is what I need to be able to collect. That's the combined contracts, or a little bit over 45 cents per option per week. The total premium desired per week would then be $45 times 2 for $90.70 for a combination. Combining these together, if I add up what the premium I'm trying to get from the call and put, it should total $90, or correction, 90 cents per option. So how do I, to choose a weekly option that will meet the objective, the above objective, I must, one, determine the expected price range of the underlying during the life of the weekly option. In other words, what is it, how far is it likely to go, the price of the IWM likely to go between now and Friday of next week. And then I add or subtract the expected range from the current price of the underlying. That tells me how wide my strikes need to be apart. And then I let that determine which strike price to sell. And I determine the probability of closing out, closing out of the money. And I want at least 75% probability that it will close out, that it will be out of the money when it expires. So here's an example. Today's date is Friday, July 10th, 2015. What is the IWM expected move between now and Friday of next week? Well, it's about approximately, when I tape this, is about $2 plus or minus $2.85. So current price of IWM at that time was about $123. So first I look at subtracting from 123.95, and this tells me that down about 121 will be where I look for a potential put. So that, let's say the 121 put. Then I add that to find out what will my potential call be. And as you can see, this would be an out of the money put and call. So I take a look and I call up the option chain. The bid ask for next week's 121 put on the IWM is selling for a bid ask of about 48 to 50 cents. The probability of it expiring out of the money is 77%. The bid ask on the IWM July 127 call is going for 18 by 19 cents with a probability of 87% out of the money. But then I go back and I ask myself the question, the total premium collected in this would be approximately 49 cents and 18 cents, 67 cents, which is shy of the 2 times desired amount. Now it's decision time. Do I basically take, accept one of these positions will be a little bit closer inside that plus or minus 285? Do I reduce the spread between the weekly put and call? So the bid ask on the IWM 126 call is equal 42 by 43 cents. So the probability of being out of the money was 75%. So if I combine both those together, I find that selling the 121 put and selling the 126 call that expire Friday of next week, which would be, I think, the 17th of July, does in fact meet our requirement, would bring in a premium of about 92 cents. Of course, then you figure out how many contracts you have to determine how much actual premium you'll be bringing in. The things to consider with a trade like this is, one is, this approach seems to work best if you're entering the positions on Thursday and Friday. That way you have more time to burn, more time value in the weekly option. Second, probability of expiring out of the money is 75%, which is a high probability, but prices can occasionally go outside of the expected range, so have a standby plan in case the index ETF does go hard either one way or the other. And then thirdly, one or both of the short options will expire worthless or close to it. So around Wednesday or Thursday of next week, I find that oftentimes these will run down to be worth a nickel, and I tend to want to buy things back once they get to a nickel. I want to go and show you where to find these in the option chain. There we go. Here is the option change I was looking at, talking about, and I taped this earlier this morning and pulled out the information on it. And as you can see, here is where I find out the potential range or the expected range for next week for the underlying, which is IWM, on this option. See, it's $2 plus or minus $2.80. And then I add or subtract that to whatever my price is at the time. Right now I'm about 124.11. I was at 123.95, and then I go in here and I find out, okay, where are the options that refer to that? As we can see, I think we highlighted the 121, 78% chance of being out of the money come close. And then we also looked at the 127, as you can see, it's up to 21 cents now, 85%, but we chose to, hey, let's go with the 126, which at that time was about 75% probability of closing outside the money come next Friday. So that's how I put the thing together. That's how I evaluate it. Those are a couple of little points on the option chain that you should be able to see regardless of who your broker is. I use Thinkorswim, and I love it because they basically, I can take this number, look at the probability of it expiring outside the money, and then I build a position around that to build a fairly high probability position. Again, I want to remind everybody that this isn't a promise of, hey, you know, it's always going to work out like this, but it has worked out well over the last few months and in the past years where I've done this since they came out with weekly options. So, hey, if you want to learn more about the 3 focal strategies of the active trend trading system, you know, please join us, become a premium member. And if you're watching this video, we do offer that at a discount rate of $29.99, which is 40% off the active trend trading membership. And then also we offer a service just for ETFs. It trades about 3 to 6 times a year for very, you know, active people who don't have time to really be into technical analysis, and we call that our early warning alerts. You can find it at the website here. So thanks for listening and have a great weekend.